Okay, so let's just go ahead and let's take a look at chapter 12 material. And let's look back at the slides. And I'm going to start with this one, okay, but just a reminder of where we were. I need to take this out of presenter view. Okay, of what we had looked at, and we had gone through the discussion of debt investments, right? Essentially buying bonds, okay? And we said that our investments can fall into three categories. We had what? We had trading. We had available for sale, which I'm going to abbreviate AFS. And then we had what? Held to maturity. Were our three categories. And remember, we had said that for our held to maturity, which is pretty much what we talked about, that we're going to carry those at amortized costs. So if there are changes in the market value of the security, that is not going to generate any unrealized losses, and so we will just carry those at amortized costs and move forward the way this schedule is showing. And we went through example of transactions in which the interest revenue was essentially the revenue that was going to be generated from that. Interest revenue was calculated by taking the carrying value of the bond, multiplying that by the interest rate. If it was the semi-annual bond, we would take that market rate and divide that by 2, right? And that would give us the interest revenue on a semi-annual basis. And then we would compare that to the cash interest, which was computed by taking the face amount of the bond times the coupon stated contract rate of interest, and that difference then would be the amortization on the discount or premium. We were working with the discount bond, so when we amortized that discount, we would do what? Since the bond is going to pay off at the face amount, we would add that discount to our interest revenue for the period to calculate our interest revenue, and we would add the amount of the discount to our carrying value. That would give us the new carrying value, and then what? We would go forward that next period, multiplying again by the market rate of interest, semi-annual, in most cases divided by 2, and so on. And so the main revenue, the only revenue that was coming out of this was going to be what? That would be generated by the interest revenue, and changes in the market value would not affect our income statement, right? Until we've ultimately sold that bond off. Okay, we went through all that. Now, we also had these other categories, trading and available for sale, and we sort of stopped there. We were going to start to go into the trading. Okay, so before we get into the other categories, and we're going to first talk about them in the context of debt securities, it turns out that trading and available for sale can also be used to classify our equity securities. One category that isn't available for equity is held to maturity, because stocks don't have a maturity, right? So it would be somewhat oxymoronic to try to put those into the held to maturity category. But for the two other categories, trading, available for sale, we'll also talk about how to account for stock investments that fall into those categories as well. But before we move into that, any question from last time related to that? No? Okay, good. So let's just go ahead and let's take a look. And you can see the carrying value of these investments at various dates. At 6 months in, it was 671. At 12/31, it's 676, 630. Again, going up by the amount of discount amortization every 6 months, right? Okay. So we come over and we started to we got into the different categories, but we then started to go through some of these examples, and I'm just going to fast forward through those, and then we got to what? To the trading securities, right? Okay, so when we're dealing with the trading security, now what? Now the intent of the company is to trade these, and it could be on a daily, could be on an hourly basis, right? So we're probably talking about a financial institution, et cetera, that makes their business buying and selling marketable securities like these bonds, okay? Now, if we have a trading security, we will carry it at fair value on the balance sheet every period. Fair value. We mark it to fair value up or down every period. Okay. Now, if we haven't sold that security yet, then we consider these up and down adjustments to the fair value of the security unrealized holding gains and losses, and we run the unrealized holding gains and losses through the income statement. It will be part of our, and of course, if we're a financial institution, it'll probably be part of our operating income. If we weren't considered a financial institution, but we still had them in the category of trading, which is possible, say a manufacturer or something, or a retail entity, then we would have it as part of our non-operating income, right? Okay, so we go ahead and we take a look, and we have this example here where the company has the amortized cost, and that comes right off the table, doesn't it? December 31st, 2018. I don't have to go back to that table, right? That was right off of the amortization table. Okay, December 31st, 2018. And they tell us that the fair value of the security is $714,943. So it's gone up in value. Okay, so we're going to write that security up in value, and we're going to have an unrealized holding gain that is going to be reported on the income statement, right? So where this thing is going. Okay, so they show you the journal entry here: debit fair value adjustment 43,464, credit the unrealized holding gain. Now, just in case, we're getting confused, what is this fair value adjustment? They're using a different account. I mean, theoretically, you could go directly to the security account. It would have the same impact. Okay, but if we were preparing the balance sheet, we would have the original cost of the marketable security investment. Okay, and the investment would be showing for the original cost of $700,000. And then we would have what? We'd have this fair value adjustment. And this fair value adjustment in this example was what? 43,646. Okay. And so since this was a debit, the investment is in debit, the fair value adjustment has a debit balance in it, we would go ahead and report the what? Net carrying value of the investment. And actually, I'm forgetting that there also be some discount on this, right? So we would also have a discount of what do we got here? Discount of how much is a discount?
Isn't the discount accounted for in the amortized cost?
Yeah, that's how I'm getting to the amortized cost, and I forgot to put the discount down. I just got to get the discount. It's the difference between the face and the carrying balance on that table, and the amortized cost.
It's 28,703.
28,703. Thank you. So we'd have the discount, which would be coming off of 28,703, and then we'll have the fair value adjustment. Fair value adjustment is this 43,646. And so the net carrying value of the investment now comes to this 714, right? And the 714,943 is now the fair value of that investment, and we're carrying it this way on the balance sheet now so that it is being reported at fair value. Okay? So we could have theoretically gone straight to the investment account, but if you use this fair value adjustment account, then you would have that, you could report that net of the discount, and you'd get the carrying amount of the investment. Okay? Bottom line, we've done what? We've marked it up to its fair value now, haven't we? Okay? Okay. Now, they tell us, and when they look at this ACS 320-10-40- 1. This is the Accounting Standards Codification. Okay, did you spend any time with that in Intermediate 1? Accounting Standards Codification. Okay, ASC stands for the Accounting Standards Codification, and the way this thing is organized is by topic, okay, subtopic, section, and paragraph. I don't know why my pen's going to start doing this. Okay, and what this is telling us here is that we do not have to mark this item to market every period. Okay, so we should, but we're going to see that the gains are going to be included in our what? In our net income. Okay. Now, ultimately, though, we may not do that as we go along, and we will just go ahead and report the entire gain or loss at the time that we actually sell the security by comparing the market value the to the sales price, whatever that happens to be. Okay, but you should start to get familiar with the Accounting Standards Codification. I'm going to check in to see if we have a university access to this so that you can start to go in and look around and see how that Accounting Standards Codification works. That's put out by the Financial Accounting Standards Board. Okay, so we go ahead and I highlighted it, and I just could have pressed the button and it would have underlined it for me. Okay, but that's the key point thing. The key point there is that trading securities fair value reported as earnings as they occur. The sale of the trading security does not necessarily give rise to a gain or loss if we've been adjusting it as we go along. Okay, so we go ahead and we take a look at the same fact pattern now, and they tell us assume that United sells the security for $725,000 on January 1st, address the trading security to fair value at the time of sale. Okay, so in this scenario now, since we already have what in the fair value adjustment, this 43,646, right? That was already in there, and now we get to the point where what we're going to go ahead and we know that that security has a higher value because they're selling it for 725, right? Before we were saying that it was worth what, 714, right? But if you're selling it for 725, then guys, it is worth 725, right? And so what happens? We need to put an additional amount in the fair value adjustment balance. And so all they do here is they go ahead and they debit fair value adjustment, and they're taking an additional gain for this 10,057. So we took the original gain here when we adjusted it up to the 714,943. That was a gain, and now we're taking an additional incremental gain for the fact that what we're going to sell it for a higher price than the 714,943. So they bring this up to the fair value adjustment, and that gets reported in the income statement. Okay. Now, the other option is, let's say we hadn't made the adjustment at the time of when we were getting ready to sell it, and we didn't make the adjustment there, but we just wait until we're actually recording the sales transaction. Well, if that's the case, then you'll obviously debit the cash for 725. We'll debit the discount because we have to get rid of that discount, right? If you're getting rid of the security, you get rid of the discount. You credit the investment in the marketable security for 700,000, and now we have a fair value adjustment of 53,703, which is essentially doing what? Getting rid of that entire fair value adjustment, right? This is all on the balance sheet, just basically taking that whole security off of the balance sheet. Okay. Now, as they mentioned, if the company didn't necessarily take that increase until they actually went and sold it, that last 10,000 increase, notice the journal entry here now is we don't have to, because if you look at it, the other one is sort of like, you know, doing the do-si-do. You put your foot in, you take it back out. Whereas here, they're just going to make the not make the adjustment to the fair value adjustment and just take the gain at the time of sale, right? And that's if they had sold it in between essentially reporting periods. Okay? Question? Question? Okay. So you could have either written it up at the time when before you went ahead and sold the thing, okay, or you could wait until you sell it. If you sell it essentially in between accounting periods, you would just go ahead and do it this way and just take it straight to net income. So in that example, we didn't run it through the fair value adjustment account, right? Is the only difference. Okay. Come over and let's take a look at the trading security impact. And so what happens? Income statement. Yes.
What are the benefits of having a fair value?
You know, any time you want to keep track of something in accounting, that's when you have an account for it. Okay. And so I sort of would look at it if you want to know how the security has moved since you've purchased it. This account will show you that at any point in time. Okay. And you'll be able to follow the bouncing ball through as it's gone up, gone down. Okay, so potentially if you're going to do some sort of financial analysis and you wanted to see how securities had moved through different ups and downs, you would be able to track that through this fair value adjustment account. If you just stick it straight into the security account, it might be a little tougher to do that analysis, you know. So there's no rule that we have to have it. The book assumes that we do. I've looked at it before where I've had this discussion where I don't use a fair value adjustment account. I just show the amounts going in and out of the investment account itself because it's a little easier to understand sometimes for that. Okay, but just think of this as sort of I guess you could call it an adjunct account to the investment account, okay, rather than call it a contra because it could actually increase it or decrease it, right? So I don't want to call it contra. I would call it an adjunct to the account. And if you sort of think of it that way, if the investment value is going up, debit it. Investment value is going down, credit it, just like you would the investment account. Okay, so but if what's behind your question is, boy, that's annoying, that fair value investment account, I agree with you, okay, because I've done it before where I've discussed it where it's gone straight to the investment account. Okay, it just depends on what you want to keep track of. I would liken it to sometimes students say, why do we have to have, sales discount account? Why don't we just debit sales instead of debiting sales discounts? And my answer is you may want to keep track as to whether or not people are keeping taking your discounts. Right? If everyone's knocking each other over to take my discount, maybe my discount's too rich, right? Too generous. If nobody ever takes my discount, maybe it's too tight, right? And you would be able to make some operational decisions based on that. So, okay. That's a good question, though. Okay, so let's go over then, and let's take a look here, and we see how we did that. Now, income statement impact, we have what? Now we have two streams of earnings going on here. We have the interest earnings. That was still going on during this time for a trading security. And what? We have the unrealized holding gains and losses that are also affecting our income statement, affecting our net income as well, right? So you got two streams of things that could affect the income statement. And of course, the ultimate sale of the security will also affect the income statement as well. Of course, that's not something that's unique to trading. Even if it was a held to maturity security, for some, we saw that unexpected reason, we decided to sell it. Remember, we saw that last time unexpectedly, and I asked you why unexpectedly, because they're trying to make sure we realize, hey, it was being called held to maturity, not fraudulently. It's just something different happened, right? And so you would have that either way, that realized. But for the trading securities, we have the interest, and then unrealized holding gains and losses are going to be affecting the income statement. They do not affect other comprehensive income. That's going to be our available for sale, and we're going to go through that here in a couple seconds. Okay, balance sheet, we're going to report those at fair value. And then cash flow statement, they're telling us pretty much operating activities. I guess they're saying if you are buying and selling those on a daily basis, that's probably your day-to-day operation. You're probably a bank or something like that. Okay, so probably go into the operating. Okay. Okay, good. Come over and you can see the impact on the financial statements, and you can see the interest revenue, right? We had the interest revenue. We had the increase. That's the increase in the fair value for that first year, right? Remember the 43,000 when we wrote it up right here, guys? 43,646. Both of those hit the income statement for a trading security. That had its impact on net income. And then on the balance sheet, now the security is showing at the 714,943, just like I have written on the board. Our retained earnings now has gone up, right, as a result of that net income. And they're reporting this in the operating activities, the cash flow, the cash received, and again, they're assuming the direct method, cash received of 42,000. Okay, is the cash impact. And then down in the operating section as well, they show the original purchase of the security. So again, if it's trading, they're assuming that's your day-to-day business, and they're putting everything in the operating section of the statement of cash flows. We see how retained earnings, we know how retained earnings got up to 90,310, right? Through our closing entries. Okay, let's make sure that we're clear on that, because I do get students from time to time that closing entries, I don't know, they were absent when closing entries were talked about or something when I try to run them through closing entries. So let's make sure we understand where we're getting these closing entries from just for these transactions. And so we would have our what? Interest revenue. Is interest revenue a credit? Huh? Interest revenue is a credit during the year, right? Debit the cash, the discount, whatever, okay? And then credit the interest revenue. Good. So at the end of the year, if I want to close it, do I have to debit it? Huh? If I want to close my interest revenue, I have to debit interest revenue for, how much was it? 45,644? 664? Thank you. Okay, good. And how about the gain? Is the gain like a revenue, but we call it a gain? Right? Okay. So we have that at 43,646. So we're going to debit the gain. 43,646. Okay, good. I want to credit something now. What do you want me to credit? Closing entries. Closing entries. This is important, guys. You got to get the income statement balance sheet connection down. One of the areas that you're going to constantly be challenged on is remembering how we connect up the balance sheet to the income statement, right? First, we prepare the income statement. Then we prepare the balance sheet. And frankly, the balance sheet won't balance until we do what? Until we do these closing entries, right? Okay. So what do you want me to credit here? Okay. Yes, but I'm going to go ahead and I'm going to add one more step to it just to make it seem like more than it is. Okay. So I'm going to go ahead and I'm going to credit income summary for the total of these, and I'm just going to steal from the board here, from the screen, is 90,310. Is that correct? It's the total of those. So I credit income summary. I credit income summary, and then what do you want me to do? You want me to debit retained earnings or credit retained earnings? Retained earning is a equity. I want to credit it, right? So I'll go ahead and I will credit retained earnings 90,310 and debit the income summary, right? Guys? Hello? Okay. Okay, I'm just doing that. I'm, not trying to insult anyone's intelligence. Just, closing entries isn't something that you wake up in the morning and say, let me review closing entries, okay? But that's how we end up with $90,310 sitting in my retained earnings at the end, right? Right? I close all my revenue expense accounts, and we're only dealing with revenue accounts. If I had expense accounts, I would have credited them here, right? And that would have put my net income in the income summary. Net income goes into retained earnings, right? Okay. All right, good. So we go ahead and we have all that sitting in for year one. Okay. Then what happens? Then in year two, we didn't, I guess they sold it on January 1st, so they didn't get any interest payments or whatever. They sold it before the interest payments, so there was no interest revenue. But we do have that increase in fair value between year one and year two, right? So that's going to show as a gain. And I'm not going to go through the closing entries again. You get it that then what? Then that gain would have been closed out to retained earnings, and our retained earnings would have gone up by the amount of gain in year two now, right? Okay. And then the entire sale of the securities down here in the statement of cash flows, and it's operating because it's a trading security. Question on trading security? Okay. Main takeaway is what? Market to market on the balance sheet. Unrealized holding gains and losses go where? Straight to the income statement, right? Okay. Okay, good. Now you come over, concept. Which of the following is false? I don't know. I don't feel like going through this. Okay, so which of the following is false? The investment account is increased, decreased to reflect fair value. The investment account is I guess they're saying that's false because they're going to use the valuation allowance account. So I'm not even sure how false that is, but anyway. Note to self, hide this question next time. It's not a very good question. Okay, let's go ahead and let's take a look at available for sale. Okay, and if we are dealing with the available for sale, we're treating this as a catch-all. So we're saying if you're not trading, if you're not held to maturity, you got nowhere else to go. So where do you go? You go to available for sale with that security. Okay, now for the balance sheet, there's absolutely no difference between what we just saw for the trading and what we're going to do for available for sale. We will market to market each period, I guess, using this valuation security account the way they have fair value adjustment account, the way they have in the example. Okay, the big difference is that unrealized holding gains and losses are not part of my net income. They are part of my other comprehensive income. Okay, so remember, did you try that experiment on the bus yesterday? Right, we said that if you do what? If you have your net income plus your other comprehensive income, that equals comprehensive income. Okay, so for the trading security, the unrealized holding gains and losses would be part of the calculation of net income. For the what? Available for sale, the unrealized holding gains and losses are not part of net income. They were a part of our other comprehensive income. Net income plus other comprehensive income is what? Comprehensive income. And I keep saying that annoying little phrase because I could potentially give you a question on the exam where I'll say, what is comprehensive income? And you're going to do what? You're going to leave out net income when what? Net income is part of comprehensive. It's net income plus other comprehensive. Yes, sir.
Does this mean we don't pay tax on these?
It does not mean that. No, tax rules are completely different. So we would be potentially paying tax on these, and I'm not a tax guy, so I don't know to what extent changes in value. Probably you don't pay any tax until you go ahead and sell the security. I would think cash basis taxpayer. So you probably wouldn't pay any tax until you sell the security, but that's not why it's OCI.
So what's the difference between accounting it in OCI and net income?
In one case, it affects net income, in the other, it doesn't. Okay. The reason that, if you're asking me why did FASB do this, FASB used to take certain things and just make them part of an adjustment to the stockholders' equity. And investors complained to FASB and that they were saying, look, we get it. We understand that there are changes in stockholders' equity by owner action, either a purchase of stock or a distribution of a dividend. We get it, how that changes the stockholders' equity, right? And we understand how net income gets into retained earnings. But at that time, they used to just go ahead and dump things straight into stockholders' equity, and there was no statement that captured that portion of the change to stockholders' equity. So what users asked FASB to do is, can you give us a different statement that will show how different things would have affected net income had they been treated as items that were run through the income statement? And so now FASB goes ahead and says, okay, we'll have a statement of comprehensive income, which will include net income, and then we'll make adjustments to net income for things called other comprehensive income. But there can certainly be tax consequences associated with these. That's not what takes them out of being considered. It's just in the past, FASB didn't make entities run those items through the income statement. And the reason FASB didn't make entities run those through the income statement is what? The income statement is supposed to capture what? More temporary type events, right? And so what happens if you have an available for sale security? Notice held to maturity, we don't do anything. There's no income statement impact at all for the changes, because why should we run something that has sort of a temporary impact as that value goes up and down as we hold it for the 3 years or whatever it is until it finally matures? So they don't make us hit the income statement, right? Trading, because we're trading every day, hey, that absolutely should hit the income statement because that's a day-to-day type thing, right? When you're in this limbo here, when you're in this purgatory, the way I called it the other day, should it hit the income statement or not? No. Okay, let's put it straight to stockholders' equity then so it doesn't mess up the income statement. Okay, but now users of financial statements are saying, but we're having trouble following all that, you nerdy accountants. Can you do us a favor and show us how it would have affected net income had you run it through the income statement? And so FASB created comprehensive income, which is net income, plus other comprehensive income items. And by the way, unrealized holding gains and losses is not the only one. We're going to study other things that would affect other comprehensive income, gives us comprehensive income. So it's just a way of presenting things that aren't hitting the aren't hitting the income statement or going straight to the balance sheet. Okay, so it's kind of one of the more this is why CPAs drive at the end of the day after they get done dealing with all this bull. They drive their very nice cars to their very nice houses, right? Because nobody else wants to be bothered with all this. So you should be glad. You should be cheering FASB. Keep coming up with the rules that are hard to understand so I can make money, right? Okay. So we run them through our other comprehensive income. Okay. So that's the main difference. Instead of sitting there and running it through the income statement, it's going to go through what? Through our other comprehensive income. Okay. So we come over. And we have the, no, it didn't change. Okay, that looked like the last slide because I picked up the wrong one. See, this is the occupational hazard. You trouble two of these. Okay, so let's go ahead and let's use the right one. And so notice we're doing the same fact pattern, guys. It's that same security that had the 671,297 carrying value with $700,000 initial investment, 28,000 left in the discount, and now they're telling us the fair value is 714,943. Same numbers we had before, right? Okay, but now we're going to see that what? We'll still write it up. This part is the same. Debit the fair value adjustment, credit the unrealized holding gain on AFS security, and so we're going to report that as part of our other comprehensive income, right? It's not net income, it's not a gain that we're reporting as part of our net income. It's part of our other comprehensive income. Now we come down, and if the thing goes up another 10,000 whatever, and in this example here they're simply telling you that you hadn't made the adjustment up until then. You need this 53,703. You've got 43, so you're going to do what? You're going to make a fair value adjustment of 10,057. Okay, now this is important because you notice that what? The additional OCI is whatever we need to bring the fair value adjustment or bring the security up to what we want it to be, right? Okay, so we put that additional 10,000. That is still part of my OCI. Okay, now if we had waited until we were getting ready to sell the security to do that, then we would go ahead actually at the time that we sell the security now, then we go ahead and we have a reclassification adjustment, which takes this 53,073 out of the OCI, and we also close the fair value adjustment account. So now the fair value adjustment account is closed, and we've adjusted this amount out of the OCI. Okay. Now here we're going ahead and we are going to take the 725. We're getting rid of the security. We are going ahead and crediting the security for the 700,000. Get rid of that. Taking the cash. Get rid of the discount. Get rid of the security. And we're taking the gain now to net income. Okay. Now you come over and let's just look at this real quick because I think it's a little bit hard to follow exactly what happened there. But if you look at this, it will be a little easier for you. So what happens? This is an available for sale security, right? Okay. And we're sitting here and we have our net income, and our net income, is that a typo? Where I come from, that's a typo, right? Net income should be 45,664. They made a mistake there, didn't they? Right? That's a typo. Sorry guys, I didn't catch that. I download the slides from the textbook, and to be honest, we don't sit there and audit them. Okay, so this should have been what? 45,644. Okay, our net income. And then what? Then we go ahead and we have what? We have, as part of our other comprehensive income, the unrealized gain. That's from year one, isn't it? Okay. Now, we go through the closing entry process, and if they had the correct numbers up here, it would have been for the interest of 45,664. And so we would have gone ahead and credited income summary for 45,644. We then would have debited income summary for what? 45,664. I know they're showing a different number for net income. That's because they messed up. I'm just picking up this number right here, right? We would have gone ahead and debited income summary for 45,644, and we would have credited retained earnings for our interest revenue, right? That's regular income, that's net income. But now we also have to close the other comprehensive income account, don't we? Okay, it's like a proprietary account. All of your revenues, all of your expenses, all of your other comprehensive income items, so I could have said all of your comprehensive income items, got to turn back to zero at the end of the year, don't they? Right? You close all those temporary accounts? Okay, so now I'm going to close my OCI, and OCI, they showed that correctly, is what? Was 43,646? Right? They give me the right number for that one. It's 43,646. Okay, so I go ahead and I'm going to debit my OCI gain here to close it. That's this account right here. Okay, that's was an OCI. So we'll call it unrealized holding gain just so that it is consistent. What's the number up there? What's the number up here? 43,646. So I'm just closing that account now. I'm closing the account that this line item. I'm just turning it back to zero, right? It was a credit. Now I'm debiting it. Where was it? When I originally adjusted it. Right here, right? That was in 2018. It was a credit. Now I'm debiting it. Is it zero again? Can I put it to retained earnings? No. Retained earnings is what? Retained earning is the beginning balance plus net income minus dividends for the year. We don't put OCI in there, do we? So we can't credit retained earnings. What are we going to credit? We're going to credit this account right here called what? Called accumulated other comprehensive income. It's like the retained earnings for our comprehensive income. So we don't put our other comprehensive income items in retained earnings. It's only what? Only our net income items go into retained earnings. So now we're going to credit this account called, and I like to just call it accumulated OCI, accumulated AOCI, accumulated other comprehensive income, 43,646. Is that how this amount got here? 43,000, where'd it go? 646. My retained earnings is how much? 46664. Where the heck are they getting these numbers from? I have no idea where they got 46664. Anybody seen that? Maybe 4-5. I don't even remember what the number was now. Whoever was doing this was smoking crack, I guess. I don't know what the heck. It was for, how much was it? Was the income? Now I don't have to go all the way back. I think they had it right in the trading. 45664. Okay, I don't know where they got an extra 1,000 into their retained earnings. Okay, but obviously their balance sheet ain't gonna balance. Okay, so they just made a mistake there. So never mind that man behind the curtain. And guess who's gonna get a call from me today? My McGraw Hill rep, and tell him, hey, clean up your act, guys. I can't be sitting here auditing your slides for you. Anyway, so it should be what, 45664? Should have been this number that got closed out the way I wrote it. Okay, and we're kind of throwing the baby out with the bathwater here. The key thing is what? The key thing is that the accumulated other comprehensive income is acting like the retained earnings of the OCI, isn't it? Okay. Okay, good. So then we go ahead and we go into the next year. And in the next year, we actually sell that security, don't we? Okay. So what happens? They go ahead and they're showing OCI for the second year. That's that 10,057. That was that incremental piece. Okay. But what happens? All of that now needs to come out of my accumulated other comprehensive income because it's going to go into retained earnings now, isn't it? Okay, so that was the reason for that reclassification adjustment, which was to get everything out of my accumulated other comprehensive income. Now it comes out, and my accumulated other comprehensive income now is going to be what? 0, isn't it? Okay, so by reclassing it out the way we saw here, where did I go? By reclassing it out the way we saw here, reclassification adjustment out of OCI, that's going to decrease my accumulated OCI, isn't it? Okay. And then what? Fair value adjustment account. That gets rid of that account because I don't need it anymore because I got rid of the security, right? So that took care of the adjustment account. That took me out of OCI, accumulated OCI now. And then what? And then I go ahead and I put the whole gain now in regular net income, right? They call that a reclassification adjustment.
Sorry, I don't understand what comprehensive income is.
Other comprehensive income?
Just comprehensive income.
Comprehensive income is net income plus other comprehensive income.
But what's the purpose of other comprehensive income? Why don't we just
I just explained it to you. Other comprehensive income was, well, again, other comprehensive income was this thing that FASB came up with because investors were complaining that there were adjustments that directly to stockholders' equity. And so they said, we don't like that. Can you show us how items would have affected net income had you included them on something like an income statement? So FASB said, okay, we come up with this concept of comprehensive income, which will include net income plus other comprehensive income items. That gives you comprehensive income.
but the money in the end still goes to the shareholders?
Well, money goes to shareholders through the payment of dividends. It is going to be in our stockholders' equity, but my explanation was that because you have these items, because if it's trading, it goes straight to net income. But you have the longer term items, which are held to maturity, in which we don't have any income statement impact at all because they don't want these wild fluctuations up and down. You have these things that are sort of in the middle that we want to mark to fair value to show how they're fluctuating on the balance sheet, but FASB chose not to have those things impact net income. So they came up with this concept of other comprehensive income, which includes net income plus, comprehensive income, which has net income plus other comprehensive income gives you comprehensive income. And we sit there and we put that on a statement called Statement of Comprehensive Income. But if you look at that, it partitions into, and you don't have to show it all in one statement approach the way they're showing here. You could actually have your income statement, which will end at net income, and then you'll have a second statement called Statement of Comprehensive Income, which will start with net income and then add the other comprehensive income items to come up with comprehensive income. But here, and you have that option. Here they're using the one statement approach. There's my net income. And then I start bringing in these other comprehensive income items, which was the increase in the value of my available for sale securities for the period, right? And that gave me comprehensive income. Now, you say eventually it's all going to go to the shareholders. And again, I went to the point of, well, if we distribute it as a dividend, it will, because we don't have to distribute it as a dividend. But if we do, it will. And how will it get to the shareholders? Probably in the form of a cash dividend. And, well, when will we get the cash? Well, we get the cash when we sell it. Well, okay, so when will it hit retained earnings? When we sell it. When we sell the security, it will hit retained earnings because we will do the reclassification adjustment. That's that debit for the reclassification adjustment. That takes it out of other comprehensive income. So now when we do the closing entries and we close that, reclassification adjustment account, when we close it, we'll close it to accumulated other comprehensive income. That'll bring it down to 0, which is where it ended up. That's where we want it to be. So we don't have any more because we sold the security. And then we'll go ahead and I keep going. Wanting to go forward, it's back. Then we'll go ahead and we'll make this entry, which is to get rid of the security, get rid of the discount, get rid of the investment, and now we're reporting this gain. This gain is going to show up, if I can ever go the right direction. What is it, forward now? This gain will show up what? Will show up as part of our net income, and it will get closed to retained earnings, okay? So all roads lead to retained earnings. Sooner or later, once you sell that security, I guess you could hold it forever, but assuming you sell it, eventually those fair market value adjustments that we've been making up and down and putting in and out of this accumulated other comprehensive income, eventually the difference, and it ends up being the difference between the original amount we bought it for and whatever the value is at the time we sell it, ends up going into our retained earnings. So I could give you a question on the test where I could give you all these ups and downs of the security and ask you what is the ultimate gain or loss. I don't know how I would describe that, And if you were sitting there, you'd be doing all the ups and downs, going up, going back down, keeping track of accumulated comprehensive income, and then taking it out of accumulated other comprehensive income and making the reclassification adjustment to put it into net income, when the answer is the difference between whatever you bought it for and what you sold it for ends up being the gain or loss. Okay? When I say whatever you bought it for and whatever you sold it for, whatever its amortized cost was at the time that you sold it and what you sold it for. Okay? Question? Okay. So we go ahead, and I just want to go back to this journal entry that got us here. We go ahead and we do what? We take the additional amount, make the fair value adjustment, putting it into my other comprehensive income for the period, right? So other comprehensive income has come up, what, 10-something this period? But then what? Then I go ahead and I do the reclassification adjustment to basically back everything out of my other comprehensive income, and I end up reporting this fair value adjustment. I reduce my fair value adjustment to get rid of it. Now, Another way to look at this, the way they did this, they disclosed the reclassification adjustment right on the face. See how you see the reclassification adjustment right on the face of the financial statement? Another way that a company could do this is they would go ahead and they would just report the 43,703, which is the amount net of the increase for the period, and they would just report 43,646, I should say. So they would just show that number. Now, if they just show you that number as their OCI for the period, are you missing some action? You're looking at that number and you're saying, okay, I guess that was the amount that was for the accumulated other comprehensive income for this security that they sold this period, which was basically last year's amount that came out. But you missed some action, didn't you? You missed the action that it actually had gone what? Had gone up, and then you sold it after that, and then there was a reclassification adjustment that took the whole amount out of the accumulated OCI. And so you can see that here. Okay, if the company chose to disclose it that way. Many companies, they'll put this in the footnotes to the financial statement. They'll show you all this detail, and all you'll see is what? 43646. That's net of what? That's net of any other unrealized holding gains or losses that occurred during the period minus reclassification adjustments. And then you would be able to see the net, and then in the footnotes they would disclose the detail. Now you sit there and you say, well, why not just do it on the face? I mean, that's much clearer and it's right there. Well, yeah, if you have one security that was available for sale security, and that was the only security that did what? Did this up thing before you sold it, but you could have some that go up and go down. This thing could get messy in a hurry, couldn't it? So what companies often will do is they'll just simply disclose in their footnotes the reclassification adjustment. Okay. Okay, good. Let's go ahead and talk about, any question on that now? On the OCI and the reclassification adjustment? Okay, good. Let's go ahead then and let's take a look at what happens if we have the securities in these categories and for whatever reason we decide to move them out. Can that happen? Can that happen? Can we have a trading security? Can we have let's say, available for sale security and say, oh, it's a trading security? Can we change our mind? Yeah. Hey, we thought we were going to hold a maturity. Sorry, we're not going to, right? And so if we change the category, then they give us instructions, FASB does, as to how we are to recognize that. I kind of have an example for that last category here that I want to make sure I have in front of me. Okay, so what happens? If we are in held to maturity or available for sale, have we been taking unrealized holding gains and losses to the income statement? If we are in held to maturity or available for sale, have we been taking gains and losses to the income statement? Huh? There's something you're going to learn about me. I'm kind of crazy. If I don't get the response I'm looking for, I'll ask the question like 52 times. Okay? That's from being an auditor. You should see the face on auditees when you ask them a question and they don't answer it and they think they're being cute. They'll say, well, how did you reconcile these two numbers if they're not balancing? And they'll give you an answer that doesn't answer the question. And so I'll say, how did you reconcile those two numbers if they don't balance? And they'll look at you like, this guy's not going away, is he? Okay, he didn't fall for my bull answer. So I'll ask again if I don't feel the human communication going on. Okay, so if we are sitting here and it's held to maturity or available for sale, have we been taking unrealized holding gains and losses to the income statement? The answer is an overwhelming now no, right? So what do? If we move it over to trading, no problem. Take all the unrealized holding gains and losses and immediately report them on the income statement. Anything you hadn't done up at that point, you will do. So you catch up, don't you? Okay, so take, for example, the held to maturity security. Let's say we had lost 10,000 in year one, 5,000 in year two, but we didn't report it because it was held to maturity, right? What would we do? We would immediately report a $15,000 loss on that security on the income statement, right? Okay. What happens if we were trading already and we go over to held to maturity or AFS? Well, if you were in trading, had you been taking unrealized holding gains and losses to the income statement? Yes, you had. So now what are you going to do? Nothing. Don't do anything. I saw this thing one time. How do you avoid shark attacks? And they're going through all these things of how to avoid shark attack. And I'm thinking, just don't go into the water. Leave the sharks alone. They won't attack you. Easy solution, right? You won't get bit. Okay, so what happens? If you don't want to get bit, don't do anything here. Just step away from the journal entries. There's nothing to do. It's already been taken on the income statement. You don't have to sit here and start reversing it back out. Just leave it alone. Okay. Now, if we were held to maturity and we go to available for sale, what are we going to do? Now we're going to catch up and we're going to take all those what? Unrealized holding gains and losses that should have been going into our other comprehensive income and piling up and accumulated other comprehensive income and what? Place them in there because we hadn't been doing that up until then. If it was held to maturity, we weren't doing anything, right? So now we'll catch up our AOIC. Okay, now this last one, well, what if you're available for sale and you go to held to maturity? What should you do? Well, they tell us that any amounts that are sitting into OCI should at that time be amortized into comprehensive income, net income over the period left outstanding on that. Obviously, if it was held to if you're putting into held to maturity, it's got to be a bond, right? So it has a fixed maturity date. Okay, and so what happens? Let's just give you an example. Let's say I had written a security up, so I have my fair value adjustment. Again, I'm using the fair value adjustment account since the book chose to use it. And since I chose the book, I guess we'll go ahead and we'll use it. Okay, and so if I've written the security up, is there a debit or a credit in my fair value adjustment? If I've written the security up, is there a debit or a credit in the fair value adjustment? Huh? If I've written the security up, is there did the security value go up or down? The security value's gone up and the fair value adjustment moves in the same direction as the security, right? So if I want to increase the security, I debit the fair value adjustment. If I want to decrease the security, I credit the fair value adjustment, right? So let's say that the fair value adjustment has gone up $10. This is an available for sale security that I'm getting ready to move over to held to maturity. And the credit here is going to be to what? What was the credit to? Good. Very good. The credit has been to what? OCI for $10 as that security has gone up, right? And ultimately it's going to be in accumulated OCI, right? Okay. Now they tell us that I have to amortize that. So let's say that the security has a 5-year life left at the time that I take it, my bond, whatever, at the time that I take it out of available for sale and put it into held to maturity, it has 5 years left. So I will go ahead now and amortize this over the remaining period, which is 5 years in this example. So for the next 5 years, what will I do? I will debit my OCI for $2. That's over the next 5 years. And I will credit what? Fair value adjustment? For $2? Is that amortizing it out of the OCI and out of the fair value adjustment for the next 5 years? Okay.
Why don't we do it all at once?
because that's not the rules. Because they want to amortize it over the remaining period of the bond. Now, if I think about it, it's a what? It's a better matching, isn't it? Over time as we're holding that security. Okay, we're sitting there and we're amortizing it over time because we're what? Really saying, hey, there's a slower process going on. As you can tell, I'm answering with style here as I go along. But the more I think about it and answer your question, if it's a held to maturity security, right, then we're saying there's a longer time horizon with this, isn't it? If you take it all to at once, now you're saying that this security is more of a short-term type of thing. So to treat it as a longer-term item over the remaining life that's left, it makes sense to properly match it over that time period.
But as long as we want to hold it until maturity, there is no point in having an LCI anymore, right? I mean,
Well, yeah, there's accumulated OCI, but you're basically backing out the effect of that over a shorter the treatment that you're prescribing would almost be a restatement type of approach to say, hey, I'm taking that whole amount out of OCI, which really it's not so much a restatement. It's not like we did something wrong before and now we have to fix it. It's, hey, we really had sort of a change in how we're treating that security, right? And so things like this, I think we tend to want to, measure more slowly over the entire period. Okay, I don't have the exact answer. I mean, sometimes students will ask me these questions and they're thinking that I should just well, here's the answer, and then I'll say that, and then you'll look at the decision as to how that was handled, and the statement will pass 4-3. How many members are there on the FASB? Financial Accounting Standards Board? You know who sets the accounting standards in the United States, right? Okay, the thing that you're not going to like about my class is I'm not going to allow you to just tune out of the class and not pay attention to what we're talking about and then just sit there and kind of work on other things in my class. If you want to work on somebody else's stuff in my class, if you want to work on my stuff, I should say, in someone else's class, that's fine. But you can't come to my class and work on your English homework or whatever it is you're working on. So you need to be paying attention, okay? And I will periodically do this where I'll come back and visit everybody and see how things are going. And, if I say, hey, make sure that you aren't watching, reruns of cartoons during the class, if I'm looking at you when I say that, you're not the person who did it. Okay? I never call out the person directly, but I will make that statement. Okay? So, what's happening? If we're sitting here and we have what? The FASB, who sets accounting standards in the United States? Financial Accounting Standards Board. Where do they get their authority? Okay. Okay, guys, you should know this. Okay, you're accounting majors. You should understand all this stuff that I'm telling you. Them's the rules, okay? You say, oh, there's got to be a better answer than that. And sometimes there's not, okay? We have what? In the United States, the Securities Exchange Commission is the entity, the government entity that in 1933, 1934 got the authority to set accounting standards. They immediately turned to the profession and said, profession, you should take this over. You should know what should be happening with accounting standards. So first it was done by different bodies, and finally in 1973 they created the Financial Accounting Standards Board. It's a 7-member board. It's like the Supreme Court of Accounting. Okay, and they make decisions as to what the accounting standards should be for various things. Now, I was on an assignment years ago where the Congress asked GAO, my office that I worked for over 26 years, asked us to look at the accounting standard setting process in the United States. We have audit authority over SEC, so we first went to SEC really to get SEC to open the door for us so that this private body, the FASB, would speak to us. And when you meet with them, you can't meet with all 7 of them at once because they could set policy in that meeting. And if it's a meeting where they could set policy, it has to be a public hearing. Okay. In fact, you can't meet with four because four could set policy. So you can meet with two. Sometimes you get to meet with three, but they try to keep you down to a couple at a time so that it's not an actual official policy meeting. And so when we talk to them, we ask them, what are some of the things that you consider when you're setting an accounting standard? And sometimes there's the desired thing that they would like to do. But if they sit there and they took the best accounting, conceptual framework approach to their answer, they would be crushed by who? By big people, by people like the Business Roundtable, by people like the Financial Executive Institute, will lobby to Congress and say, if you let them pass this standard, the terrorists have won. I mean, they'll say whatever it is they have to say to make sure that this particular standard doesn't go through the way they want it to, doesn't go through the way FASB's thinking. They want it to go through the way they want it to because it impacts their financial reporting, right? So when I answer these questions, just to give you a little bit of the background, I try to come up with a theoretical answer, but sometimes there is none. Okay, it's just what they thought they could get through at that time. So it becomes almost a legislative process, right? Okay, but I'm thinking that, because they can't just say, well, we're doing this because of political pressure. Although at that time they told us they wanted to do an approach, and we'll talk about this in an upcoming chapter, as to how to account for stock options that are given to, potential or given to employees instead of pay. They'll give you a stock option and you stay for 2 years and you work real hard, and then you can go ahead and cash those in after a couple years. Well, the way the standards work, where they set that option price would dictate whether or not they would take an expense on their income statement. Well, if you think about that, the ability of a company to set a price and that dictates the recognition of an expense is a poor accounting theory. And so they wanted to come up with a model that would allow them to estimate the value of those stock options, and they would have to take an expense for that value. They shouldn't have done that. Companies didn't like that one bit because what's happening? Couple things. One, executives get those stock options. And if you start putting the cost of an executive stock option on the income statement, likely investors are going to say, hang on a minute now. What are you talking about? That should have been my money. It's reduced the net income. It should have gone into retained earnings. Instead, you set the price so low, you didn't have to take any expense, is the way it worked before. So what happened? They went to Congress. The Business Roundtable, others went to Congress and said, don't let FASB do this. Do not let them set the standard that way. And Congress introduced legislation at that time to say that if the FASB wants to add a project to its agenda, it has to first go and get approval from the SEC. Well, if you're a board and you don't set your own agenda, you are no longer a board, right? FASB saw the writing on the wall, backed off from that, and decided not to do what they knew was the theoretically sounder approach, and they left the old approach in place because the business community was not ready to accept that change. Now what happens? About 5-6 years later, you had a scandal with these stock options where companies were going and backdating the dates to make sure that they could delay the time to when they would take the expenses. And when that scandal hit, then FASB said, and they went ahead and they said, here, now do it the way we were talking about. And nobody argued with them at that point, right? So when they're trying to lead, if they get too far in front of the people they're trying to lead, right? You've made that mistake before. You say, hey, follow me. And then you're driving and all of a sudden you look, where's the person that was following me, right? So you have to modulate your speed to keep them behind you, don't you? So since they were going too fast, but once the time was right, they went ahead and they put that in place, and we'll learn how that works at that time. Anyway, a lot more than you asked for, but I'm thinking, okay, that the reasoning is, and you can always look up, they give their reasoning, and you'll have a 4-3 vote, and it's possible that 3 people were agreeing with you. Take it all at once. 4 people said, no, we should recognize it over time since this is held in maturity. I don't know. Okay, I'm not sure what the decision process was on that. Okay. All right. Any question on this one now? Okay. Okay, good. IFRS. Good. This is a good transition. IFRS stands for what? Good. Spoken like true prodigies. International Financial Reporting Standards are IFRS, right? Who uses IFRS? Huh? I wouldn't say except the United States. There are a lot of countries, over 100, that use IFRS. Okay, many countries don't use IFRS. For example, um, I was in China talking about taking the U.S. CPA exam in China, and some folks are interested in, Chinese citizens are interested in taking the U.S. CPA exam because they work for either companies that want to be foreign listed companies in the U.S., or in some cases it's where there's a foreign parent and the U.S. company is the subsidiary. And in those situations, SEC sometimes will look at the staff that are sitting there and say, your staff does not have sufficient U.S. GAAP knowledge. So the company that I teach the CPA exam for found a market where there could be people in different countries. We went to China, Japan, the Middle East in different years, a couple different years I went to talk about taking the U.S. CPA exam overseas. And so in the discussions, we asked them, well, the Ministry of Finance in China has said that you have adopted IFRS. Is that true? And they said, well, kind of true. What the Ministry of Finance has done is they've cherry-picked parts of IFRS that they like. Other parts of IFRS that they don't like, they don't use. But they called that a transition over to IFRS. Other countries like Japan, they don't even touch IFRS. They don't use it at all. So it really depends on the country. And if you take a look at the map, and you'll see these maps where they'll show you all these, dark blue countries using IFRS, and then the light blue countries, including there's the U.S. sitting there not using IFRS. I saw a map like that one time. Do not use it. But if you look, it's usually the emerging economies looking for a set of accounting standards that take IFRS. So UAE, United Arab Emirates, they use IFRS lock, stock, and barrel. Other countries that had an established economy and adopted their own accounting standards before IFRS probably are still following their own what they call sovereign accounting standards, their own domestic accounting standards still, and U.S. being one of them. U.S., there was a time, probably about the time you guys were probably like in the 3rd grade, they used to say, it's not a question of if, but when the United States will go over to IFRS. Do you still hear that? You still hear that sometimes? People still say that? Not a question of if, but when? I mean, maybe after they drop an atomic bomb and they start all over again or something. I don't know. But as long as we currently have the same system, the United States will not go over to IFRS. Okay? Why? Well, let's take a look at one thing of IFRS that the U.S. doesn't want to adopt. IFRS says that you cannot use the last in, first out method for accounting for your inventory, right? Last in, first out. If you have a period of rising prices, last in, first out will give you a lower net income, won't it? Lower net income, lower taxes, right? Okay, and so what happens? There's the Lifo conformity rule that says that if you use Lifo for tax purposes, you must use it for financial reporting purposes. In other words, we're not going to have you paying less tax and then reporting to your stockholders that you had a higher net income. That's not going to work. So you have to use it for what? For both methods, right? Both tax purposes and for book reporting, for financial reporting purposes. So what happens? You sit here, and if you switch over to IFRS, you eliminate US GAAP, you eliminate the ability to use last in, first out inventory method for financial reporting purposes. If you don't use it for financial reporting purposes, you can't use it for tax purposes. If you can't use it for tax purposes, higher net income, higher taxes. Do companies like to pay taxes? No, so they get their lobbyists out there early to go and say, don't let the U.S. go over to IFRS. If you do, the terrorists have won. I don't know. I'm not making a joke of terrorists. I'm just saying they'll come up with whatever, right? They'll fill in the blank as to the bad that will happen if they allow that. And so because of that, the SEC felt the pressure of Congress right away to not allow a switch over to IFRS. And that's just one issue that I'm talking about. And if you do any research on this, if you give the Congress and the president something to argue about, what will they do? If you give the Congress something to argue about, what will they do? Argue. If you give them something to argue about, they will do what? Argue. And so it would be constantly locked up. And you see what's going on with healthcare and all that, right? And it was going to work the same way with switching over to IFRS. So what FASB and the International Accounting Standards Board did is they adopted a similar conceptual framework, and they call this convergence, that over time they're hoping that their standards will get as close as they can, but they will never be, and this is John talking, I mean, they haven't declared this, I'm just telling you, I don't think because of our system, I don't think they'll ever be completely on the same page, okay? All right, so having said all that, what happens? When you do your transfers out of the different categories, in and out of the different categories, IFRS is much stricter in allowing you to do that. Okay, they're going to basically say that you have to look at your entire business model in how you're handling your securities. And if you've changed over your overall business model and how you're handling your securities, then you can go ahead and move these in and out of the categories, trading to invest, trading to available for sale, whatever. With U.S. GAAP, the transition is considered more liberal. Okay, and that's all we're going to say there in terms of a difference. Okay. Okay, good. Let's go ahead then. And let's take a look at, I've got to get rid of some of these dumb questions. I don't care about these. The only thing cool about this is watching that circle come over. Okay, so what? If we're sitting here and we have this available for sale, and a bond has amortized cost of $800,000, the fair value adjustment has been debited, right, to bring it up $20,000, but the bonds now have a fair value of $5,000. What are we going to do? We'll debit the fair value adjustment. What kind of security is it? Available for sale? Where's the credit going? There's the debit. Where's the credit going? OCI. Beautiful. Good. There it is. Okay, nice. All right, we are going to go past these couple of things, and I want to get us into basically the equity investments, but I'm feeling maybe there's need for a little break, okay? So why don't we go ahead and take what, 10 or 15? 10? 15? Dumbest question ever asked, okay? All right, that's all right, because I know you need to get on your cell phone and say, oh, yes, I still love you, or whatever it is. So go ahead and do that, and we'll come back at, 5 after, 10 after, okay? Okay? All right, guys, I'll go by that clock. No, 10. Huh? Oh, 10:30? Yeah, 10:30. 10:30.
Okay, so
Yeah.
no Berkeley time.
Not really. I mean, if I get stuck or something, resume this, and we were going to start to talk about our equity investments. So we spent time talking about our debt investments, right? And one of the key things I want to get out right at the beginning here is that for our equity investments, our stock investments, we are going to see that we're going to have the same three categories. Even though they don't necessarily call it trading, it is like the trading category, okay? And then we're going to have what? We're going to have available for sale, and for the, so I guess I shouldn't say we have the same three categories, because for stocks, there is no what? Held to maturity, okay? So we really only have to deal with trading and the available for sale, and the treatment is exactly the same. If it's a trading, unrealized holding gains and losses go where? Straight to the income statement. If it's available for sale, unrealized holding gains and losses will be part of our other comprehensive income. Okay. Now, we're going to see that there are a couple of different methods to account for our investment in stock. One is called the, it's not called the cost method anymore. It's called, It's called fair value through net income. Right? They couldn't just keep a method, easy to remember name like cost. And now it's going to be fair value through net income method, okay, to account for our stock investments. And then there's another method called the equity method. Now, why do we have to have these two methods? Well, if you're buying stock in a company and you own, say, 2% of the stock, can you control what that company decides to do? No, unless everybody else holds 0.5% or something, or 0.1%. But just generally speaking, 2%, right? You can't influence that company, right? What if you hold 40% of the stock? Can you control the decisions that that company makes? Oh, yeah, 40%. That's getting pretty significant, okay? That's the rule of thumb anyway, right? Now, if it's not, then you would still use the fair value through net income method, not the equity, okay? But potentially, when you start getting into those larger numbers, 40% is a number I just picked out of the air, okay? Then they say that you can control that company, and what you will do is you will account for that investment as though you owned the company. And it's going to change how we will treat different things like the net income of the investee, the dividends that are paid out, etc. Okay? This is just an overview of where we're going. Okay? We're going to get into the details here as we go through. Okay? So when we take a look, we will purchase the investment. We will account for, again, we're focusing now on equity, so it's going to be dividends, okay? And then we will have the unrealized holding gains and losses as there's changes in fair value for both our trading and our available for sale. Again, for our equity, there is no held to maturity. And then, of course, once we sell the investment, there'll be gains and loss on the sale. So as you can see, very similar to what we've already learned here, right, for both for the debt. But then, again, our different categories, we don't have held to maturity. And, of course, stock doesn't, bonds don't pay dividends. We're going to see how we account for the dividends. And then we've got the two different methods, which is what? Which is the equity and the fair value through net income approach. Okay, so we take a look, and if we are taking the fair value through net income approach, the assumption is that we do not exert significant influence over that company that we've purchased their stock. Okay, now we're talking about stocks now, right? And so if that's the case, we will use the fair value through net income method, and it is sort of the same thing that we've seen for the trading securities. We will take unrealized holding gains and losses, mark to market on the balance sheet. Unrealized holding gains and losses will go through the income statement, right? Okay. And if there is a dividend, that dividend will be treated as a income from the investment, a dividend revenue. Okay. Okay. Now, that's if we are less than 20%. If we have purchased 20% or more of the stock up to 50%, then we will use the equity method. With the equity method, we do not mark the security to market on the balance sheet. We will basically take our original cost, and our original cost will be increased by our share of the investee's income. So if the investee had $100,000 of income and we own $40,000 of stock, we will debit the investment $40,000. We will credit investment income $40,000 because we're taking what? Our share of our investee's income, right? Dividends are treated as though they are a distribution of earnings. So dividends will actually reduce the value of the investment on the balance sheet as we get distributed out those earnings under the equity method. Okay? Now, a couple questions that I get a lot of times. What if it's 21%? Well, look, the 20% is a rule of thumb that we will use in this class, okay? And we're going to see that there will be instances, even though I don't think I have any problems like that, I'm going to warn you and remind you that there could be a situation where you own less than 20%, but you will still use the equity method because you exert what? Significant influence over the company. So in that situation, they're saying, hey, you own 20, but everybody else owns 2%. Well, now you do exert the significant influence. So even though you're below the 20, you're going to see what? that you will use the equity method, or at least I'll remind you of that. There will be other times where you're more than 20, say you're 30%, but somebody else exerts significant influence. If that's the case, you'll use the fair value through net income method. And so you have to read the question carefully. Those percentages are rule of thumb, but you also have to read, do they tell you whether or not they exert significant influence or not, right? Now, if they say nothing, then that means you should assume that you use the 20% rule. So it's a rule of thumb. It's not an absolute, okay? And then if you go past 50%, 50.000001, whatever, then you should consolidate the financial statements of the parent, the investor, and the investee. And when you consolidate the statements, you treat them as though they are one company. Okay? Comment on this slide. They say combine the statements. That is not. It is not a combination. It is a consolidation. Combining means what? I'm going to take company A and I'm going to pour everything in company A into company B and vice versa, mix them up. Now they're combined, right? That is not what I do when I consolidate. Consolidation will eliminate if there were intercompany transactions. If company A and company B had a transaction, we would eliminate that transaction for our financial reporting purposes. So now it looks like what? One company. That's called consolidation. That is beyond the scope of this class. The consolidation is something that you'll do in advanced. Okay, and definitely by the time you're taking CPA exams, that kind of stuff, we expect you to know consolidation. Question? Okay, good. So let's just go ahead and let's take a look at this situation here. And we are less than 20%. Oh, that's an important point. We're talking voting shares here. If we have preferred stock, we do not include that in the discussion of whether or not we exert significant influence. So if the question tells you something about the preferred stock, what do? How do you avoid shark attacks? Leave it alone. Don't touch it. It won't bother you, right? Okay, so just leave that alone if you see that in a problem. Only deal with what? The voting shares, okay? Okay, so we're sitting here and we're less than 20%, so we're going to use this fair value through net income method. I mean, can they come up with a more annoying title of what to use, okay? All right, so what happens? We sit here and we have this company purchase this stock, $1,500,000. There is a dividend of $75,000, and there is a fair value adjustment that needs to be made in that what? They value the investment to $1,450,000, and then they sell it a little later for $1,446. Okay, so let's just go through and see how we're going to account for all these. And they do a nice job giving us the journal entries. There's the purchase of the security. Then what? There's the dividend. How easy is that? If you get a cash dividend, debit the cash, credit the investment revenue. Piece of cake, right? Okay, dividend revenue, whatever, from the investment. And then what? And then when we look, it was 1,450, and the cost was $1,500,000. We lost a little on the value of this thing, didn't we? Okay, and so we will go ahead, and this is kind of silly the way they're doing this. It was 0 before. Now you need to credit the fair value adjustment account. The what? Fair value adjustment account is a surrogate for the account itself, isn't it? Right? And so what happens? Since we would have credited the investment to reduce it, we credit the fair value adjustment account, right? To get it to the 50. And they kind of did it this way. It's 0. Now it's 50. Well, if you had nothing in there, you know you got to put 50 to bring it to 50, right? Question? So we got two things going on here, right? The revenue, but also what? Just like we saw for the stock, the fair value adjustments, right? Okay, just like we did for the trading securities. Okay, now we come over and we take a look and notice, oh, yeah, on the income statement, unrealized net income, the loss, right? And we have the credit to fair value adjustment, $50,000. Question? Okay. If you're waiting for deeper meaning, there is none. It's pretty much, this is it, right? It's fair value through net income adjustment. Okay, good. Then what? Then we go ahead and when we sell the security, there's a $54,000 difference. Okay, they're getting ready to sell it. And so we had what? We had the 50. We need 4,000 more in there, don't we? So what do? We go ahead and we debit the unrealized loss 4,000 and credit the fair value adjustment to bring it up to 54. Okay? So anytime you're looking at a problem, guys, and they're asking you what is the amount that should be put into the fair value adjustment, and I took my piece of tape off, so I'll drop this like about 12 more times before the class is over. And we have this fair value adjustment. You do what? Any given year, the amount of loss or gain you recognize is whatever you need to bring it from what its beginning balance was to what its ending balance should be based on the comparison between the actual cost and the current fair value. Okay, and then we go ahead and when we sell the security, we debit the cash, we credit the fair value, we credit the investment. No need for any reclassification adjustment because what? Everything ran through net income already, didn't it? Okay, good. In this one, the fair value is 1.3, cost was 1.5, and they're telling us what? We need a 200,000 fair value adjustment, so we need an additional 150. I don't know. I'm not sure why we even have this. Note to self, hide this. Okay, we've seen the situation already where you make the adjustment to the net income. Okay, so we just saw that twice, I guess, for some reason. Okay, balance sheet. On the balance sheet, current or non-current, depending on what? This is a stock. So it depends on, does anyone come to you and say, hey, time to give up that stock? Depends on the intent is what I'm looking at, right? What does the company intend to do, right, is what governs it. Okay? Okay, good. Cash flow, if it is a short term, that's considered operating activity. If it is a what? Long term, we consider everything investing activity. Okay? And then in the footnotes, we're going to have disclosures about unrealized gains and losses for the period, I guess. I'm not exactly sure what they want us to put there. Okay? All right, good. Come over and let's take a look. Which of the following is false? And let's just do the little circle. Makes me feel like going to the circus. It's that game where you throw the hoops around things. Okay, so what happens? Security should remain on the balance sheet at amortized cost. That's false. We're going to mark it to what? We're going to mark it to market, as we've seen through these using this fair value adjustment account. Oh, I see. And after sale, you take them off the books, obviously. You sell an asset, you don't show it on your balance sheet anymore, right? Okay. And they're not at amortized cost. Okay. Okay, good. Let's go ahead and let's take a look. If we have more than, when we use the equity method, now we're what? We're more than 20, but we're less than 50. If we go to 50, we consolidate, right? Or past 50? 50.0000001, then we go to consolidate. Okay. Significant influence means that decisions can be swayed in the direction of the investor. So what happens if I tell you that you own 25% and the remaining 75% is owned by another entity? Should you still use the 20%? Should you still use the equity method at that point, I should say? Huh? No, because what? The significant influence rests with somebody else at that point, doesn't it? So it has to be what? We use the 20% as a rule of thumb, but the real determiner to the equity method is the phrase significant influence, right? Okay. Okay, good. So let's take a look and see if we're more than 50%, we will consolidate. That's all I'm going to say. Okay, don't worry about the rest of that. Let's get into the equity method. So now we're in equity method. We can see because we are at 30%. Okay? And you take a look here and notice that they tell us we have land and they give us the books, the book value. This is what the company bought the land for. If you buy land in the Bay Area in I don't know, 1974 for $50,000, how much is that land worth now? Would you guess? Something a lot more, right? Unless they found nuclear waste on it or something. But assuming, the land doesn't have creatures that come out of the ground and eat you, right? People are willing to do what? Willing to pay more for that land now, right? Okay. But what should it be carried at? What's your name, sir? Bryce. Bryce. What should it be carried at on the financial statements of the entity? 1.2 or 50? Right. No. Okay. No. No, for something like in assets, like fixed assets, like buildings, land, equipment, we carry them at our original cost. Of course, with building and equipment, less accumulated depreciation. I asked about land because land doesn't depreciate typically, right? Okay, land is either there or it's not there anymore, right? And when it's not there anymore, we write it off. Like if California got knocked off the face of the earth or something from an earthquake, then we'd write off all the land, right? Let's hope that doesn't happen. Probably, some people on the East Coast go to sleep at night saying, please let California not be there in the morning or in the middle of the city, middle of the country. They may feel that, but we're here, right? So what happens? Land never goes away, right? So you don't depreciate land, but for things like fixed assets, buildings, equipment, land, we put them at their original cost. Okay. Now, why does FASB require that? Remember those 7 guys? Now they have women too. At the time that I was there, they were all men. But the time I interviewed them, they were all men. But now I think they have women that are also on the FASB. By the way, not a bad gig, guys. Not a bad thing for you to shoot for. Coming from UC Berkeley, accounting degree. Moving on up, they pay you about $500,000 a year to be a member of the FASB. You got to move to Connecticut. It's not a bad place to live, and or the East Coast because they're in Connecticut. You could live in New York and commute into Connecticut. You won't have much traffic going from New York to Connecticut. It's like coming from San Francisco to Oakland in the morning. It's not that bad. The other way is the worst way. Okay, but $500,000 a year, and you get to sit there and make all these decisions, right? And the reason that FASB decided to do this actually it's probably the FASB's predecessors, but whatever. The standard setters decided to do this is because things like building, land has a very subjective view. And if you don't believe me, just go look through a catalog of houses that are for sale, right? And you'll see a house where the guy says, I want $1.5 million. And you look at that house and you're like, what a piece of junk. That place smelled when we went in there. I would not give that guy. Did you smell that? What was that? He wants 1 point. Ha 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 ha. You come by the next day and you find out that the house got sold for 1.7. Right? So the value of things like property is highly subjective. It's in the eyes of the beholder at any point in time, isn't it? So what happens? To remove that subjectivity, FASB says, carry it at your cost. Less depreciation, the land there is not. Carry it at your cost. That's the most objective way of valuing something like that. And then when the new person buys it for 1.7, now we have what? An objective measure because the person put cash over the barrelhead for that. Now we can carry that asset at 1.7, and now the new person carries it at 1.7 going forward. Okay? Now, what happens? For other assets like financial instruments, like stock, there is a readily determinable value of a stock. It gets listed every single day, and everybody agrees and goes to the New York Stock Exchange and says, oh, we all agree that that's the price of the stock, right? And everybody agrees to that at the end of the day. And so what happens? Then with that, we've removed subjectivity, so things like stocks can be carried at fair value, bonds that are listed, etc. Okay? Now, we're going to probably talk about this in a little while. You say, well, hang on, John. What if the stock isn't listed on the stock exchanges? Now what? What if it's my brother's company stock? What should I do? Well, they tell you to start to look at stock exchanges are level 1 inputs. they have you start to look at level 2 and level 3 inputs. Level 2 inputs, you would look for a similar stock and see if you can kind of back into the value that way. Level 3 input would be that you look at measures such as net income that's going to be coming, and they'd rather you use the level 1 before you use the level 2 before you use the level 3. Level 3 is the worst. Okay, so one that you can use, but in the absence of anything else, you have to use that. Okay, now, but so that's stocks, right? But let's just go back to this equipment and stuff, right? Okay, so what happens? Well, if I buy 30% of the stock of the company, more than 20, in this case 30, in effect, I am buying those assets. So there is this objective measure of what I'm willing to pay for these assets that are sitting on the books, right? And so when we go and we look at the equity method, since the assumption is that you're buying the company, you're going to exert significant influence, we're going to use the fair value to measure what's going on with this investment as opposed to the book value. Okay, so that's why we're showing you the difference. The company's carrying it at book value, but when we come over and we look at the fair value, we see there is a difference. You know, that building is worth what, $1 million more? That land is worth $500,000 more. The other assets are around $60,000. Now this is annoying as hell, guys, and I don't mean to use the H word or whatever word I just used. Okay, and that the net assets equal the total of the assets. Isn't that annoying? What are net assets? How do we calculate net assets? Assets minus, what's your favorite song? Your favorite song is assets equal liabilities plus stockholders' equity, isn't it? You walk around, assets equal liabilities plus stockholders' equity, right? But you ever listen to the jazz station where all of a sudden, you know, a song by Kelly Clarkson is being played some weird way, and then all of a sudden you go, oh, that's who sings I'm gonna make it roar, but they're playing it on a jazzy style. What's her name? What's the lady that sings that song? You don't recognize it? See? I'm the eye of the tiger. You don't know that song? Roar? Huh? Okay, Katy Perry. But then they play it on the jazz station, and you're like, huh? Is that same song? Right? And then all of a sudden you go, oh yeah, it is. I recognize it now. Okay, so I'm going to play jazz with this. I'm going to say assets equal, minus liabilities equals stockholders' equity. Does that work too? Okay, and another name for stockholders' equity is net assets. So now I'm changing the words to the song a little bit. Now what? Now we're calling stockholders' equity net assets. Okay, so when they sit here and they're just making this easy by showing you the assets, okay, you would do this analysis of the difference between the book value and the fair value, not only of the assets, but also what? The liabilities, okay? And so in this case, they are assuming that there are no liabilities in this company, which is a ridiculous assumption, right? So this is a little annoying, but they wanted to make this as easy as possible, okay? So we go ahead and we have the net assets, which actually so happen to equal the total assets here. And what happens? We go ahead and we say that the total fair value of this company now is 3.6. We paid how much for it? How much did we pay? 1.5 million of cash, didn't we? Okay. So what's happening? If you sit here and you look, we're paying more than the fair value for these assets. We're paying what? 150,000 when to get 30% of 3,600,000, we should pay what? If you just use the fair value, 2 plus 1 plus 6 is 3,600,000 times 0.3 is how much? Huh? 1,200,000? Huh? What is it? 1,800,000? Calculators? Anybody got a calculator? Huh? 1,800,000? Okay. 1,080,000? Okay. Like that? We're all in agreement? That's the number. How much are we actually paying for this thing? 1,500,000, are we? So we're paying more than the fair value for these assets. If we pay more than the fair value for these assets, we are purchasing something that is not tangible. Is not something that you can just look at, like a piece of land, like a piece of equipment. And so that difference is considered goodwill. For example, let's say you go to a restaurant, and not this whole amount is not goodwill. The difference between what? The 1,500,000 and the 1.8 is going to be our goodwill, right? For example, you go to a restaurant and you have all this equipment, and you go and you look at the equipment of the restaurant. The place is a mess, right? Lousy stoves. They look like they're going to blow up tomorrow, right? Just the upholstery and the seats is bad, etc. And your significant other takes you there, and you go, why did you take me to this horrible place? What is wrong with you, right? And then you eat the food and you go, oh, I'm in love again, right? Okay? So what happens? If you were just to buy the assets of that restaurant, you'd go up to the guy and you'd say, hey, I'll give you $5,000 for all this junk you have in here. And he'd say, security, throw this person out, because that person knows, the owner of the restaurant knows that what? Hey, I'll make $5,000 in a day at this place with selling the food and stuff, right? So what happens? There's goodwill over and above what you can see in those assets, right? Okay, so even though we're looking at the assets and what? There's 3.6 million worth, and if we were buying 30% of that, we should only pay 1,080,000. We are paying more than the fair value of the assets. That difference is considered what? Considered goodwill. Okay? Question? Okay, now here they're doing it on the overall purchase, but I want to deal with, our transaction. Okay, so they're doing it on the overall company here, but we're not buying 100% of everything. We're buying what? We're simply buying this 30%. So we're paying 150, and they're saying there must be a $500,000 value there. That addition, if you're paying 150, that additional value is 140. But I like to look at it, the amount over and above what I paid versus the fair value of what I've got is the goodwill that I'm purchasing. Okay, good. So what is that number? Anyway, let's put it explicitly on there. How much am I paying? Huh? I'm paying $1,500,000 cash, right? And I purchased tangible fair value of $1,080,000. Are we all in agreement on that number now? Okay. So I have goodwill then of what? How much? 420? Okay, good. What did they say the goodwill was up here? 1,400,000. 1,400,000 times 30% is how much? Huh? 420? Okay. So all I'm showing you is the way I like to calculate it is right here. I just look at the difference between what I paid versus the fair value of what I purchased. That difference is what? Goodwill. Is there a question, guys? Guys, you can just bring the question up here. Other people may have the same question. No? Okay, good. Okay, so what's happening? We're sitting here, and that's the goodwill that we purchased, okay? Now, what happens? Well, when we go Now, and we account for this investment since we're at 30%. We're going to go ahead and let me erase all this is in the way now. And we're going to do what? We'll debit the investment. We'll credit the cash. So the investment's being carried at $1,500,000, which is what we paid for that stock, whatever, right? And we credit the cash. Then what? Then we go ahead and we take the 500,000, which is the other information, this is the investee's net income, was 500,000. Okay, and we take what? We take our share. If the investee had 500,000, we own 30%. We're using the equity method. We have significant influence, right? 30% of that stock. And so we go ahead and we debit the investment account and we credit investment revenue for our share of their income, right? Then we come over and they tell us that there was a dividend that was paid out. The dividends that were paid out were $250,000, and since we own 30% of the company, 30% of that belongs to us, right? So they pay us the dividend, and we credit the investment account. Notice the difference between this and the fair value through net income approach. With the dividend received, that was our investment revenue, right? Here, our investment revenue is our share. When we're in the equity method, our investment revenue is our share of the entity's net income. The dividend is like a cash out, isn't it? Okay. Question? Okay, good. Now, before we go to that concept check, where's the goodwill? We do not report goodwill. We do not report goodwill until we consolidate the financial statements. If we were to go past the 50% and there was a goodwill considered in the purchase price, then we would go ahead and we would only report goodwill. Okay, hear me on this, guys, because this gets confusing. And I could very well ask you a question on the test where I'll say, here was the information. What is the goodwill to be reported on? And I'll probably make it the investor's balance sheet. And the answer is going to be what? 0. You don't report goodwill until we go to the consolidation process, and we'll have a way of calculating the goodwill there. So even though I could ask you what is the goodwill, and if I ask you what's the goodwill, you can calculate it, but if I ask you what's the goodwill reported on and typically we'll call out the investor's balance sheet, goodwill is not reported. You would simply use the equity method the way we just described. Show the investment, increase it for the investee's share, investor's share of the investee's net income, reduce it for the investor's share of the investee's dividends that were paid out, right? Okay. Now, the equity method. You know what I'm going to do? I'm going to go have Saturday night. I'm going to have a glass of wine. I'm going to sit there and watch these things go over. I think that'll be great. All right. So what happens? The equity method, and we say views the dividend payment as returning assets to its investee in the form of a cash payment. Isn't that what the dividend does? Was a payout? Okay. Okay. Good. You come over and. Further adjustments. What's going to happen? They are going to require us then, after we've done what we just saw, pretty easy, the little more subtle point here is they are going to require us to go ahead and take an additional depreciation here for those depreciable assets that had a higher fair value. So after we've done everything and we've taken the revenue for our share of the investee's revenue, which, by the way, when the investee calculated their net income, they were calculating their net income based on the book value of those assets, weren't they? But part of this transaction, we said that we purchased that higher fair value. Well, if it had a higher fair value, then depreciable assets should have a higher depreciation, shouldn't they? So we will literally reduce our investment income for an increased depreciation because we consider those assets at a higher value. Okay? So let's just go ahead and let's take a look. And we're sitting there And we have what? Again, they show us this difference is goodwill. Again, we don't report that anywhere. And we have what? We have the 500,000 is the cost. That's 1.5. The assets that the fair value of the assets that we purchased was 360, and so we really only purchased 1,080,000. The difference is 420. I already did that calculation for you, right? Okay, and so they tell us that our share of the book value is 630. So we've got a what? The difference between the fair value and the book value of the assets is sitting here, right? But some of that is what? Some of that is land. We don't depreciate land. 300,000 of that, though, is what? Is attributable to the building. So this difference, if you take this total difference, which is what? The 450 here? Is that 450? Right? This 450, 300,000 they're saying is attributable to the building, 150 is attributable to the land. Are we going to depreciate the land? Are we going to depreciate the land? No, so we're going to only calculate excess depreciation on the building. So we go ahead and we say, okay, well, we have this difference in the difference between the book value and the fair value of the building is what? 2 million. It was 2 million. It was being carried at $1 million, so we have a difference of how much? $1 million. And they told us that it has a what? Has a 10-year life, right? So that means there's additional depreciation of how much? 100,000 a year, and I own what percent of that? 30,000. So I'm going to debit my investment revenue and credit my investment in the stock. So I'm taking back some of that net income, right? Remember before I took my share of their net income by debiting the investment and crediting the revenue? Now I'm taking some of that back for this extra depreciation, right? On the building. Okay. Question? Okay. That's it. If you're waiting for deeper meaning, there is none. Land is what? Not depreciated. Goodwill, and they say it is not amortized. It's not reported. It is not reported on the unconsolidated statements. It's only when you get to the consolidated statements that it is reported, and it is not amortized. It is subject to an impairment test. Why don't we amortize, essentially depreciate goodwill? Why not depreciate goodwill? Goodwill could go on forever. I mean, who would have thunk it that when Disney drew a mouse and his girlfriend, that 50 years later we'd be sitting here going, yeah. Right? So we don't know. They may have McDonald's in outer space. They probably will. On your way to Mars, when what's his name? Tesla dude gets you to go to Mars on a bus. You'll be sitting there and you'll go, oh, can you stop at McDonald's on the way? Right? So we don't know how long goodwill will go. So we don't depreciate goodwill. We don't amortize it. However, we do what? We do evaluate it for impairment. So you have a nice airline that's doing real well, and then something like this happens, then they would have to look at that whole situation and see if their goodwill has been impaired, and they'd have to write it down. Okay? But you don't report it until you do what? Until you consolidate. Okay? Okay, good. Yeah, and then original cost plus the investor's share of the investee's net income minus what? Minus their share of the dividends, and then this isn't showing here, but what? Any additional calculations that need to be made for extra depreciation, etc., right? This is a good slide. This is probably pretty much it, right? Okay, good. That gives us, we'll deal with this next time. We'll deal with this tomorrow. Okay, so tomorrow what we're going to do is we're going to go through the quiz. Okay, I'm going to go through the quiz in detail. We'll start with that because this point on this slide about a mid-year acquisition, I think we can handle pretty well in the questions. Okay, so we're done with the slides. We'll meet tomorrow. We'll go through the quiz. We will meet. We'll talk about Monday on Friday. Okay, and obviously we'll be here on Tuesday. And I'm thinking Tuesday is when we'll be launching headlong into chapter 14. 13. Okay, guys? All right, have a good rest of the day. I will see you tomorrow. Hi, sure.
Can I ask this one? Because you just mentioned the journal entry, and we name it as investment revenue and investment in edged stock.
Mhm.
But since it is a cumulative depreciation, can we when we do this journal entry and we name it as accumulated depreciation on this item?
Only if we were doing a consolidation. Right now, we're still treating it as an investment of a separate company. And since we're treating it as an investment of a separate company, it doesn't affect our depreciation.
But actually, the depreciation will be counted even if we haven't
No,
consolidated it.
on the company of the investee, on the financial statements of the investee company, they still calculate their depreciation based on the million. They're going to do their depreciation based on the million. We're accounting for our investment, recognizing the fact that we have purchased a portion of those assets and we purchased them at a higher fair value.
Okay.
And so we back that out of the investment account. It reduces the investment income
Okay.
and reduces the investment.
Okay, got it. So, and about the depreciation method, we assume that we use the weighted
Straight.
average.
No, this assumes straight line. Straight line. Yeah,
line.
this assumes straight line. Yes.
Okay. Okay, got it. Thank you so much.
I'm not sure. I think you would just use straight line even if the company was using another method. It doesn't matter. We just use straight line.
Okay.
Yeah.
Okay. Thank you so
Yeah,
much.
sure.
We're going to have a little test tomorrow because I heard that the quiz is going on tomorrow.
The quiz is up there already on.
Yeah, so we're just going to discuss.
Bring that one, and I'm going to go through that one with you tomorrow. If you're not here, you're not here, but I'll go through that tomorrow.
Oh, I see.
Yeah, but it's not a timed quiz or anything like that. So you'll get the points regardless. Okay?
I'm so sorry I thought there was no class tomorrow because today is my boyfriend's birthday. I'm going to LA tonight, so.
Well, that's not a good excuse. No, I'm just kidding. That's fine. We'll go through the quiz tomorrow. I'll record it, and you can watch us going through. It's fine.
Okay.
Yeah.
Quizzes. Where can we get the recording?
I'm going to post them up on.
Record?
No, up on Canvas. Up on B courses. Yeah, B courses. Sorry. Yeah, I'm going to put it up there under the chapter. Okay.
Thanks.
Okay, sure. Hi, how you doing? Good.
Did you take attendance
I did
this
not.
morning? Okay,
No.
okay. I wasn't sure if you take attendance every class. Or
I don't. I'll probably have a sign-in sheet at some point, but I'm not worried about it right now.
Okay.
I usually don't start instituting sign-in sheets when people start missing all the classes.
All right, cool. Because
Yeah.
I wasn't here the first class, so I just wanted to make sure.
Oh, okay. No, that's
Two
fine.
in a row or
Oh,
something
okay.
like that.
No,
All right,
I'm not looking at that.
All right, thanks.
Okay.
Bruce.
Okay. See you.